What's up, guys? Hey, it's Clint Coons here, and in this video, I'm going to share with you some financing options when it comes to rental real estate and using limited liability companies or business entities. All right, let's get started. Okay, so when it comes to financing, the easiest way to put a deal together, of course, is to not use financing and use cash. So if I wanted to buy a piece of property right here, and I was going to close on it, and I was going to set up a structure. If you're buying for cash, of course, you can set up a limited liability company, set up an LLC, and you can actually close directly in the name of the LLC. Now, many times people will ask, if I'm going to buy property with an LLC, do the funds need to come from that limited liability company for closing purposes? Now, that's not so important here. It doesn't matter where the funds will come from, originate from, when you close on this piece of property. So maybe you have a structure set up where you have a Wyoming limited liability company right over here, and that Wyoming LLC has your funds, and so you're going to wire to title for closing for escrow purposes right out of this LLC on behalf of buying it over here. That works. I've done that before. I've sent it from myself. You don't necessarily need to have the account opened up in the LLC. The only time I've ever run into a scenario where I needed to have cash in the limited liability company for closing is when I was buying from banks. Probably about 10 years ago, when I was buying these REO deals from banks, they required that in order to close, that the funds actually came from the LLC. Now, I haven't done a deal like that in 10 years, so things may have changed and they may be a little more relaxed that way in setting these deals up. So that's how you can buy for cash. Set up the LLC, close in the name of the LLC. They just want the money wired to them and you're good to go. All right. Now, the second method that a lot of people like to use for their real estate transactions is traditional financing. So you're going to go to a broker, right? You're going to apply for a loan. And if it's residential real estate, you're thinking, hey, I've got this LLC that I've set up right here, and I want to close in the name of this limited liability company. But the problem is you can't close in the name of this LLC because that broker is issuing you a Freddie Fannie conforming note. Most brokers you deal with, that's how they're underwriting the note. So Freddie Fannie requires that if you're buying residential real estate, you have to close in the individual's name. It's got to be in an individual's name. It can't be in a business entity. So in this type of scenario, what you'll end up doing is you'll end up closing on the property, of course, in your own name, and then after it's closed, you can then deed it to the LLC. Now, if any of you are concerned about the due on sale clause, I have another video. We'll put that in the show notes about Freddie Fannie and how that works. But I'll tell you this, it's not an issue. When you buy a property in your own name, it's a Freddie Fannie conforming mortgage, you can transfer it into an LLC and you don't have to worry about that due on sale clause that so many people like to talk about, but don't fully understand how it can be implemented against you. One other point that I would like to bring up here, when you're buying with traditional financing, let's assume you need 20% down. Do not forget that you have to buy with seasoned funds. You know what I'm talking about? Seasoned funds. That means this money needs to come from your personal checking account. They need to trace it. So you have to show that that money was in your account for 2 months. Why do I bring this up? Because you could make a mistake, and I'm guilty of this myself. You find a piece of property, you weren't expecting to buy it, you're going to use traditional financing, and your cash is over here in that Wyoming LLC that you're using for asset protection. So I have a Wyoming LLC set up where I hold my cash, and I need now $80,000 for closing on this property, but it's not in my personal checking account. It's actually over here. So I take a quick distribution, drop it down in my personal checking account. They ask for 2 months of bank statements and they say, wait, where did this 80K come from? And then they just start sniffing, oh, you got an LLC, and things start to go off the rails there with the underwriter. So if you know that you're going to be buying and you know about that approximate price range and you're using a strategy like I just showed you, make sure you season your down payment. Pull it out of the LLC, put it in your checking account so you have 2 bank statements, 3's even better, to show that you have that down payment in your account. And so the lender now, the underwriter, will not know that you had this other LLC set up. All right, so that's traditional financing. Another way, of course, that you can finance your real estate purchases is through private money. Okay, so what's private money? Well, that's where you're going to find someone. Maybe it's your Uncle Ted who's going to loan you the funds in order to acquire this house. So if you have a private lender set up, then there's absolutely no reason why you can't close in the name of a limited liability company. Because when you're dealing with a private lender, they don't care where you're going to close. They're not selling that note, so it doesn't have to fall into the same Freddie Fannie guidelines. So they'll allow you to close directly into an LLC. So that's if you're going to use private money, plan on closing into that limited liability company. Now, another option you have when it comes to buying real estate is to use seller financing. Okay, maybe it's a land contract. So if you're going to buy property where the seller is going to carry the note. Why would a seller want to do this? Well, because they want to get the interest money, because they realize, hey, if I bring in $300,000, I have nowhere to put that where I'm going to get a rate of return. So instead, I'll have you pay me 4% interest because it's better than the 0.04% interest I'm going to make on my money if it's held with a bank. So they'll be willing to seller finance you this property. Now again, in a seller finance scenario, it's like working with a private money scenario. That is, the lender or the seller is not going to care how you take title of the property because like the private money scenario, they're going to protect themselves by filing a deed of trust against the house. So they have collateral protection there. And they'll probably ask you to give them a personal guarantee here as well. So they could come after you if you defaulted and they sell it and they can't get all their money out of it because you destroyed the property, something like that. So seller financing, definitely you can buy in a limited liability company. There's no issue. Now, this brings me to my next way to acquire real estate. It's a method that I actually used when I first got started, and that is hard money, okay? So hard money is another way to buy real estate. Now, before you look at me and you think, what the heck is he talking about hard money? We all know that hard money means this. Pain, right? You're going to pay points and you're going to pay a much higher interest rate. Well, typically if you're buying residential real estate and you want to use hard money, you're going into the deal for a very short period of time. And hard money lenders prefer borrowers who are in the deal for a short period of time because they want to get their money back out so they can turn around and loan it back out again because they're making their money, yes, off interest, but more off of points. The more they turn it, the more points they make on those loans. So when you're buying for hard money, you could buy in a limited liability company like this, okay? You could buy in the LLC, again, because the hard money lender is not going to care how you take title to this property. Because again, they're going to secure it the same way I talked to you about. But here's the thing. If you're buying residential real estate for hard money, you're not going to stay in a hard money relationship. When I started investing in real estate, I would bring in a hard money lender. They would finance 100% of the deal, okay? So they would bring it in, maybe I was out a couple grand, I'm out $3K, they finance this deal for $80,000. Then I would rehab the property, bring the value up after the rehab to $115,000. And then 2 months later, I would go to a traditional bank, we'll call that TB, and I would refinance out my hard money lender because I now had the built-in equity into the property after the rehab that I would have sufficient debt to equity ratio there that would allow me to do a cash or no cash out of pocket refi on this property. I'm not pulling any cash out. All I'm doing is refining out the hard money lender. So I would take them out, they get their 80K back, I own the property. Now the thing about this though, if this is your strategy, you need to know who you're going to refinance out. So when I was doing my refis, I was using a community lender. I was not using the traditional broker to do these deals. And so when you're dealing with a community lender, they're going to allow you, because they're going to treat it as a portfolio loan, that they're holding it, they're not selling it. They're not going to fall under Freddie Fannie guidelines, which states you got to close in your own name like a traditional lender's loan is going to do to you. So I could set my deals up initially in a limited liability company. So if you want to do this and you're going to use a hard money loan in this scenario, you need to know this lender right here. This is crucial, guys. You can't do this outright unless you know where you're going to refinance out of. If you're going to use a community bank here to put this deal together, fine, do it in the LLC. But if you're going to use a traditional lender, then I would avoid setting it up in a limited liability company. I would close in my own name, refi in my own name, or rehab in my own name, then refi it. After that's done, then put it in the limited liability company. You don't want to get caught up with any seasoning issues like the money, but also with the property, where a lender might tell you, hey, that property needs to be in your own name for 6 months before we'll do a refi on that deal. On a non-cash out refi, typically that's not going to be a problem, but why have the multiple deeds going back and forth if you know you're using a traditional broker and you're going to have to pull it out anyway? So that's what I would look at if I'm using hard money. Know my back-end exit strategy, who I'm borrowing those funds from to take out the hard money lender and set it up that way. The last thing I want to share with you is I think is really important. If you're investing with traditional financing, okay, you have to be careful on how you're setting up your deal. So I recently spoke to an individual who became a new platinum client of Anderson's, and we were having a discussion. His problem was this. He said, hey, I can only buy through traditional financing 3 more properties. And I knew from talking to this client that he's married. Okay, so he and his wife, they're real estate investors, and we're creating for them 7 limited liability companies to protect their existing 7 properties. And when he told me that he can only qualify for 3 more, I knew immediately what his problem was. I said, hey, I can double that for you, but if you're going down the same road, you're going to get capped out. And he goes, yeah, I heard this, that I can only get 10 properties with traditional financing. That is correct. Typically, they impose a 10 loan limit for you. Now, his mistake was when he started borrowing on these other properties right here with traditional lenders. So going back to my second strategy on how to finance real estate or purchase real estate, he was putting himself and his wife on as the borrower. So both of them were going on the loan. This can be a problem for you if you're trying to grow your portfolio and you want to use traditional financing. Because if you both go on the loan, then they're going to look at you as one party and they're going to impose that 10 loan limit on you. When in reality, if only one party went on the loan, this party could do 10, this party could do 10 deals. So now you could actually acquire 20. Now what comes up typically when I have that conversation with people, like we did here, I said, hey, I can bump you up to 6, so I can double what you could still qualify for, but you have to put one spouse on. The initial response is, well, what happens if she leaves me? I said, well, be nicer to her, okay? And then that won't happen. But the reality is this, is that when you do that, after you get your loan in place, then you can bring that back into your rental real estate structure where you have your limited liability companies. So you close in your name, in one spouse's name right here, and then you transfer the property into the LLC, and that LLC is going to be owned by your Wyoming holding company right here, of which, of course, you and your spouse own 50-50. So it doesn't matter that only one spouse went on the loan. We're going to transfer ownership right away into this structure where both of us own it together, and that eliminates that concern for those individuals who think, well, if that spouse goes on it, then they own it, and I'll never get a piece of that if they choose to leave me. No, that won't happen. Anyways, guys, a lot of different options there when it comes to acquiring real estate, to finance it, to use entities. Make sure you know your strategy ahead of time so you can set it up the right way. You know what to do with that like button, and be sure to subscribe to my channel as well so you can find out about all the other great content that I have coming out in the next several months that can help you with your tax and asset protection for rental real estate. Take care.